Hello and welcome. This is Professor Farhat. In this session, we would look at the equity method. This topic is typically covered in intermediate accounting as well as in advanced accounting. So if you want a more detailed explanation about the equity method, please go to my advanced accounting course. But this topic is also covered in intermediate accounting. Obviously, this topic is covered on the CPA exam, the FAR regulation. You want to make sure you understand this topic before sitting for the exam. As always, I would like to remind you to connect with me on LinkedIn if you haven't done so. YouTube is where you would need to subscribe. I have 1,600 plus accounting, auditing, finance, and tax lectures. This is a list of all the courses that I cover, including CPA questions. If you like my lectures, please like them. It doesn't cost you anything. Share them. Put them in the playlist. If they benefit you, it means they might benefit other people. And please connect with me on Instagram. On my website, farhatlectures.com, you have resources that's going to help you prepare for the exam, CPA exam, such as true, false, multiple choice, PowerPoint slides, notes. And if you are serious about your CPA, 2,000 plus CPA questions, I strongly suggest you take a look at my website. So let's talk about the equity method of investment. Remember, we're talking about equity. We're talking about stocks. How do we account for our investment in stocks? Well, it all depends on the degree of control. And we talked about this in the prior two sessions when we talked about the fair value method. First, if you own between 0 to 20% of a certain company, let's assume Amazon or Microsoft. If you own between 0 to 20%, well, you are considered to be a passive investor with a passive interest. It means you really have no saying in the company. As a result, you would use the fair value method, which we already covered this method. If you own between 20 to 50%, and that's quite a lot, then you are considered to have significant influence. And once you have a significant influence, we use this method that we're going to be talking about today, the equity method. So you have to be careful on the exam day, whether you are taking the CPA exam or in your accounting course. Oftentimes, the exercise, the problems that you are solving, it doesn't specifically says you have significant influence. They will tell you something like this: you own 30 or 32%, without telling you it's significant influence. From an accounting perspective, if you own that much, you assume to have significant influence. Okay? If you own more than 50%, well, more than 50%, guess what? I'm in control. You have a controlling interest. When you have a controlling interest, you have to use the consolidation method. You have to consolidate the financial statements, whether using the cost or the equity method. And this topic is covered heavily in my advanced accounting. So if you are taking advanced accounting or you're going to be taking advanced accounting in the future, check out my advanced accounting course. Now let's review real quick. If you own less than 20%, you would use the fair value method. We would recognize the adjustment of unrealized holding gain or loss in net income, which we already covered this topic. Look in this playlist. If you own between 20 to 50, this is what we're going to be discussing today, the equity method. Unrealized holding gain or loss, there's no such thing. And we're going to proportionate share of investees' net income. We're going to see what this is. Holding more than 50%, it's consolidation, nothing recognized and not applicable, and we don't learn about this in this course. So let's take a look at the accounting for the equity method. Okay. If you own between 20 to 50%, what does that mean? It means, let's assume this is the person, and this person owns between 20 to 50%. Well, if you do so, we assume that you have some influence, some significant influence. Maybe you can vote the board of directors, or 1 or 2 members, or 3 members. Or maybe you have between 20 to 50 and the rest are small accounts. So you have more influence than other people. So you assume to have a significant influence. So any investment, direct or indirect, sometimes you might own a company that owns shares in other companies. Well, you own that company. You don't have to own it directly. Of 20% or more of the voting stock of an investee should lead to the presumption that in the absence of evidence to the contrary, an investor has the ability to exercise significant influence. You have some saying. If that's the case, we have to use the equity method, basically saying the same thing again and again and again. Now, how do we account for the equity method? It's a pretty straightforward method. So let's take a look at the rules of how to account for it. First, record the investment at cost. There shouldn't be no surprise here. If you buy an investment, you initially record the investment at cost. It's as simple as that. Just like you buy any other investment. Stocks, bonds, inventory, property, plant, and equipment. You initially record them at cost. So let's take a look at this example. You purchased 30% for Star Company common stock, and you paid $75,000. So you made investment in this company called Star, and you paid $75,000. Journalize the entry. Well, easy. I made an investment in equity securities, $75,000. I paid cash. I credit cash $75,000. Well, now I have an account called investment in equity securities, and I have in there $75,000. So what happened after you invest in this company? Subsequently, adjust the amount each period for the investor proportionate share of earnings and dividend received by the investor. What does that mean? Well, once you are an owner in this company, which you are now an owner, and you have significant influence because you own 30%, what's going to happen is this. You are going to ignore the market price fluctuation. So simply put, if the stock price of Star goes up, if the stock price of Star goes down, it doesn't concern you. Why? Because you have a significant influence. You're going to be using the equity method. We don't care about adjusting the investment up or adjusting the investment down. Investment in equity, and we have in there $75,000. So let's assume Star Company reported net income of $10,000 for the year. Well, the company, your subsidiary, made $10,000. Well, if that's $10,000 for the whole company, you technically earned 30% of that, which is $3,000. Now you're going to adjust your investment in the proportionate share of the earning. Well, what's your earning? Proportionate share, $3,000. So you're going to increase your investment. You're going to debit investment, $3,000, to increase your investment. And you're going to credit an account called revenue from equity investment. Basically, this is revenue for you. Okay? Revenue or earnings from equity investment. So as the company report net earnings or net loss, if you have a net loss, your investment will go down. But here we're assuming you have net earning. Now, what else could happen? Star Company paid $6,000 in dividend. Remember, the company made $10,000? They decided to pay $6,000. Well, if they paid $6,000, how much do we get as the parent company? 6,000 times 30%, and that should be 1,800. So we're going to debit cash 1,800. What do we credit? And this is where students have issue. When I ask in my class, what do we credit? Most students, they will say, we'll credit dividend revenue. And that's incorrect. We don't credit dividend revenue for the equity method. We already earned all the revenue that we're supposed to earn. The total revenue that we earned from Star is $3,000. We already accounted for it. So simply put, this money is, think of this revenue, think of it, it's at the bank. We earned all the revenue that we're supposed to, and it's in the bank. Just follow the example with me. All what you did now is you took the revenue in cash, because the dividend, where the dividend comes out of? Dividend comes out of net income. You already reported your net income. You reported $3,000 of net income. What's going to happen now is you're taking the cash out. When you take the cash out, you cannot count it as income again. If anything, it's reducing your investment. It's reducing your bank account. Now your investment goes down by $1,800. So subsequently, what we're saying is this: as your subsidiary earns a profit, we debit investment to increase the investment account. As the subsidiaries pay dividend, we reduce the investment account. Now also, if we incur losses, we reduce the investment account. Okay, so this is what you need to know about the equity investment. Now the equity investment goes a little bit further in advanced accounting. You would learn about other topics. So this is simple introductory equity method, but you may need to know a little bit more in your advanced accounting, but this is a good start. Now what happens if you keep on incurring losses? First of all, let's see what the balance of the investment is at the end of the period. So this way, kind of, we don't lose track. So simply put, it went up by $3,000. it went down by 1,800, and we started with 75,000. So we have 78,000. Let me see. So net, we went up 7,200. So if my math is right, your investment should be 76,200. Now, what happened if you keep on incurring losses and paying out dividend? Well, this account could go down to zero. And once it's down to zero, you don't reduce it anymore. So the investor share of investees' losses exceed the carrying amount. What's the carrying amount? The carrying amount right now is 76,200. The investors ordinarily should discontinue applying the equity method and not recognize any additional losses. So this account could go down to zero. You cannot have a credit investment account. It's an asset. Okay. And to illustrate the concept, let's look at the fair value versus the equity method. This way you can see things side by side. So under this column, we're going to account for the transaction as we are using the fair value method, which we learned in the prior session. In this column, we're going to look at it as we are looking at the equity method. On January 2nd, Maxi Company acquired 48,000 shares, which is 20% of mini common stock at a cost of $10. Under the fair value method, we're going to debit investment, equity investment, 48,000, credit cash. Under the equity investment, we're going to debit equity investment or investment and equity, it doesn't matter, for 480,000, not 48,000. So notice they're the same. So initially, when we record the investment, we record it at cost, whether we are using the fair value or the equity method. At the end of the year, the subsidiary reported 200,000. What is our share? Our share is 20%, so our share of profit is 40,000. Well, under the fair value, it doesn't matter what we reported, that's irrelevant for us, therefore we don't do anything. For the equity method, we're going to debit investment for 40,000, we're going to increase investment for 40,000 and increase investment income or earnings from investments or revenue from investments. It doesn't matter. Okay, so we debit investment, credit investment income. Now I said revenue, you're better off using earnings from investment if you want to use the other term, not revenue. Okay. So this is the entry that we make to adjust the investment upward. Now, if you want to keep track of the investment, the equity investment, you started with 480, and now you have an additional 40,000. Now, on December 31st, 48,000 shares of Mini has a fair value of $12. Notice you bought them for 10, they went up to 12, you have a gain of $2 per share. So you're going to debit fair value adjustment, 96,000. If you don't know how to do this, go back to my prior session when we talked about how to adjust the portfolio. Credit unrealized holding gain income, 96,000. This is under the fair value. Under the equity method, we don't do anything. So we ignore market price fluctuation because we are not adjusting our investment up or down based on the market price. We are adjusting our investment up or down based on the net income generated by the subsidiaries and the dividend received from the subsidiary. On January 28, Mini Company announced and paid cash of $100,000. Maxi received 20% or 20,000. Well, under the fair value, we're going to debit cash, credit dividend revenue. So under the fair value, that's the entry, debit cash, credit dividend revenue. Under the equity method, we're going to still debit cash. Cash is still going to go up, but we're going to reduce our equity investment because we already accounted for all the income or all the revenue that we're supposed to account for from that company. So now we reduce the investment. We made the profit, then they gave us the profit, therefore we reduce the investment. At this point, 480 plus 20, which is 40 minus 20 is 20. Our investment is at $500,000. For year 2021, Mini reported a net loss of $50,000. For the fair value, we don't care. We report net loss or net income. We don't care. We need to take a look at the company stock's price fluctuation. Under the equity method, here's what's going to happen now. Our investment's going to go down. We're going to debit investment loss because our share of the loss is 10,000. 50,000 times 20% is 10,000. And we are going to reduce our equity investment. Now, our equity investment went down by 10,000. Now our equity investment is 490. On December 31st, the company shares were trading at $11 or 528,000. Well, here what we need to do, we need to adjust our portfolio down. We're going to debit unrealized holding gain or loss income, 48,000, because we went down $1 from the prior price. The prior price was 12. Now we are at 11. We have to reduce our portfolio by $1 times 48,000 shares, and we credit fair value adjustment. If you don't understand what's going on this side, it's because you don't understand how to account for the fair value. Under the equity method, we have no entry because under the equity method, the price fluctuation is ignored. So this is how we account for both transactions, for both method, fair value and equity method. Make sure you understand the difference between them. Investment in equity securities when we have more than 50% control. Now this individual owns more than 50% of the stocks. Now this individual can control everything. Now you have a controlling interest. One corporation, let's assume this is the corporation, acquire a voting interest of more than 50%, then they have a control power. Investor corporation is referred to as the parent. This is the parent company. And the subsidiaries, those are the subsidiaries, and the investee are referred to as the subsidiaries. We own more than 50%. Investment in the subsidiaries is reported on the parent's balance sheet as a long-term investment. So when they report their investments, when they report their balance sheet, all these are reported as investments. Parent generally prepare consolidated financial statements. As I mentioned earlier, this topic is covered in advanced accounting. So if you're interested, you could go to my advanced accounting. And when I talk about the parent company, think of the company Gap, the Gap store. The Gap store owns Old Navy. Okay. So the Gap company is the parent company. Old Navy is the subsidiary. Or we can say the Gap store is the investor. The investor. And Old Navy is the investee. The investee. Okay? And basically this is the equity method. In the next session, we would look at the fair value option, not the fair value method. We're going to look at the fair value option. As always, I would like to remind you to visit my website if you're interested in studying a little bit further, preparing for the exam. Your investment in your career is long-term, especially if you're studying for your CPA exam. Go ahead, invest, subscribe. You'll have access to more information, which will help you propel your career, and it will pay down dividend 10, 15, 20 years down the road. Good luck and study hard.